ETFs democratize investing, offering a user-friendly way to tap into a basket of assets with a single trade, providing simplicity, transparency, and cost-effectiveness. ETFs offer instant diversification across multiple assets, mitigating risk and allowing you to tailor investments to your interests and beliefs about future trends. ETFs captivate investors with their cost-effectiveness, flexibility, transparency, tax efficiency, and accessibility, making them a preferred investment vehicle. Global ETF indexes provide broad market exposure, growth potential, currency diversification, and simplicity, helping investors tap into international growth opportunities. The S&P 500 ETF offers instant diversification across major U.S. sectors, a track record of solid returns, liquidity, and low costs, making it a cornerstone for many portfolios. The MSCI World ETF provides broad international exposure, sector diversification, and a convenient way to invest in developed markets worldwide. The FTSE All-World ETF offers comprehensive global diversification, including emerging markets providing exposure to a wide range of sectors and geographies. The Nasdaq 100 ETF provides exposure to leading technology companies, offering potential for substantial returns but with higher volatility. The MSCI Emerging Markets ETF offers exposure to rapidly developing economies, presenting significant growth potential but with higher risks. Section 1. Diversification, the cornerstone of ETF index investing. In the world of investing, diversification is often touted as the closest thing to a free lunch. It's the art of not putting all your eggs in one basket, and ETF indexes excel at providing this essential ingredient for a well-balanced portfolio. Think of it like this. Would you rather bet your entire savings on a single horse race or spread your bets across multiple races with different horses? When you invest in an ETF index like the S&P 500, you're essentially buying a small piece of 500 different companies. This broad exposure across various sectors, from technology and healthcare to energy and consumer goods, acts as a safety net for your portfolio. If one sector stumbles, others can potentially cushion the fall, providing a smoother ride for your investments. Imagine, for instance, that a breakthrough in renewable energy sends shockwaves through the energy sector. While traditional energy companies might experience a downturn, companies in the renewable energy space could soar. An ETF index that encompasses both sectors would help you navigate this shift, potentially capitalizing on the growth of renewables while mitigating losses from traditional energy. This diversification magic isn't limited to sectors. Global ETF indexes like the MSCI World or FTSE All World take it a step further by spreading your investments across different countries and currencies. This international exposure acts as a hedge against economic downturns in any single region, providing a level of stability that's hard to achieve with individual stock picking. Section 2. Cost efficiency, maximizing returns with ETFs. In investing, every dollar saved on fees is a dollar earned. ETFs offer a cost-effective way to invest in a diversified basket of assets. Unlike mutual funds, ETFs have lower expense ratios and management fees. ETFs track an index, reducing the need for active management. Lower costs can significantly impact your long-term returns. Even small differences in fees can compound over time. ETF investors can potentially supercharge their wealth-building journey. Section 3. Riding the wave of potential high returns. While past performance is never a guarantee of future success, ETF indexes have a history of delivering solid returns, making them an attractive option for investors seeking long-term growth. Of course, the specific returns vary depending on the index you choose. A tech-heavy index like the Nasdaq 100 might offer higher growth potential than a broader market index like the S&P 500, but the general trend is clear. ETF indexes have the potential to grow your wealth over time. Think of it like riding a wave. While there might be ups and downs along the way, the overall trajectory of the wave is upwards. Similarly, ETF indexes, by tracking the performance of a basket of assets, aim to capture the overall upward trend of the market. While individual stocks within the index might fluctuate, the index as a whole tends to move in a positive direction over the long term. Of course, no investment is without risk. Market downturns are inevitable and ETF indexes are not immune to these fluctuations. However, their diversified nature helps mitigate losses during market dips. When one sector or company stumbles, others can potentially pick up the slack, providing a smoother ride for your investments compared to holding individual stocks. It's also important to remember that investing is a marathon, not a sprint. While it's tempting to chase short-term gains, the real magic of ETF index investing happens over the long term. By staying invested through market cycles and reinvesting dividends, you can potentially harness the power of compounding, turning those small gains into significant wealth over time. Section 4. Transparency and Simplicity, ETFs Demystified. One of the most appealing aspects of ETF indexes is their transparency. Unlike some investment vehicles that seem shrouded in mystery, ETFs lay their cards on the table, providing clear insights into their holdings and performance. This transparency empowers investors to make informed decisions, aligning their investments with their risk tolerance and financial goals. Think of it like reading the ingredients list on a food label. You want to know exactly what you're putting into your body, and the same goes for your investments. With ETFs, you can easily access information about the underlying assets, the index tracking methodology, and the expense ratio, allowing you to make informed choices that align with your investment philosophy. This transparency extends to the trading process as well. ETFs trade on major stock exchanges just like individual stocks, with real-time pricing and transparency in buying and selling. You can see the bid and ask prices, the trading volume, and the ETF's current market value, giving you a clear picture of the investment landscape before making any decisions. This simplicity and transparency make ETFs an ideal choice for both seasoned investors and newcomers to the market. Whether you're a seasoned pro with a deep understanding of market mechanics, or a novice investor just dipping your toes into the water, ETFs provide a user-friendly way to access a diversified basket of assets with clear and concise information at your fingertips. Section 5. Building a resilient portfolio with ETF indexes. In the ever-evolving landscape of the financial markets, building a resilient portfolio is paramount. ETF indexes, with their diversification, cost efficiency, potential for high returns, and transparency, offer a powerful set of tools for constructing a portfolio that can weather market storms and potentially thrive over the long term. Think of your investment portfolio as a house. You wouldn't build a house on a shaky foundation, and the same goes for your investments. ETF indexes, by spreading your risk across multiple assets, provide a solid foundation for your portfolio, reducing the impact of any single investment's performance on your overall financial well-being. Just as a house needs a sturdy roof to protect it from the elements, your investment portfolio needs protection from market volatility. ETF indexes, by tracking a basket of assets, provide a level of diversification that can help cushion the blow during market downturns, potentially smoothing out the ride for your investments. And just as a house benefits from regular maintenance, your investment portfolio needs periodic checkups to ensure it's still aligned with your financial goals and risk tolerance. As your life circumstances change, so too should your investment strategy. ETF indexes, with their flexibility and ease of trading, make it easy to adjust your portfolio as needed, adding or removing exposure to different sectors or asset classes to reflect your evolving financial needs. Section 1. The Art of ETF Rotation, a Balancing Act. In investing, change is constant. ETF rotation is a balancing act. Adapt to market shifts, but avoid knee-jerk reactions. Balance long-term growth with strategic adjustments. Review and adjust your portfolio for future growth. Navigate changing winds like a seasoned captain. Section 2. Spotting the warning signs. Identifying underperforming ETFs. Recognizing when an ETF is veering off course is crucial. Compare the ETF's performance to its benchmark index. If it lags, investigate further. Compare to similar ETFs. Consistent underperformance warrants action. Trust your instincts and make tough decisions. Section 3. Navigating market shifts. Recognizing sector rotation opportunities. Just as ocean currents shift, so do financial markets. Different sectors cycle through growth and contraction. Recognizing these sector rotation opportunities is essential for savvy ETF investors. Stay informed, adapt to market conditions, and make strategic adjustments to your ETF holdings. Section 4. Due diligence researching potential replacements. Conduct thorough research to find potential replacements for underperforming ETFs. Define your investment objectives and risk tolerance. Examine expense ratios, trading volumes, and tracking error. Scrutinize the ETF's underlying holdings. Consult reputable sources and financial advisors. Knowledge is power for making sound investment choices. Section 5. Timing the rotation. Weighing the costs and benefits. Timing is crucial in ETF investing. Knowing when to execute a rotation is as important as identifying underperforming ETFs. Weigh the potential costs and benefits to ensure alignment with your strategy. Consider trading commissions and tax implications. Consult with a tax advisor to understand potential consequences. Timing also depends on market conditions and your investment horizon. Ultimately, the decision is based on your circumstances and goals. A dynamic approach, embracing change for long-term growth. The world of ETF investing is not static. It's a dynamic landscape shaped by ever-changing economic conditions, geopolitical events, technological advancements, and investor sentiment. To thrive in this environment, it's essential to embrace a dynamic approach, one that's adaptable, informed, and proactive in seeking out opportunities while mitigating potential risks. This dynamic approach involves staying informed about market trends, monitoring your ETF holdings regularly, and being willing to make adjustments as needed. It's not about chasing the latest hot ETF or trying to time the market perfectly. It's about making strategic decisions based on careful analysis, a long-term perspective, and a deep understanding of your investment goals and risk tolerance. Think of it like tending a garden. You wouldn't simply plant your seeds and then ignore them hoping for the best. You'd water them, fertilize them, and prune them as needed to ensure they have the best chance of thriving. Similarly, managing your ETF portfolio requires ongoing attention and adjustments to ensure it's aligned with your financial goals and positioned for long-term growth. Embrace the fluidity of the markets and view change not as a threat, but as an opportunity to refine your strategy, capitalize on emerging trends, and potentially enhance your returns. Remember, the most successful investors are not those who fear change, but those who embrace it and adapt accordingly. Tracking performance your ETF scorecard. Keeping a watchful eye on your ETF investments is essential for long-term success. Think of it like tracking the progress of your favorite sports team. You wouldn't just check the standings once a season, you'd follow their games, analyze their stats, and look for areas where they could improve. Similarly, monitoring your ETF's performance helps you make informed decisions about whether to hold, buy more, or consider a rotation. Start by establishing a regular schedule for reviewing your ETF portfolio. Some investors prefer a monthly check-in, while others opt for a quarterly or semi-annual review. The key is to find a frequency that works for you and stick to it consistently. During each review, compare your ETF's performance to its benchmark index. Is it keeping pace, or is it lagging behind? If it's consistently underperforming, it's time to dig deeper and investigate the reasons why. Next, compare your ETF's performance to its peers. Look for ETFs tracking the same index or sector and see how your ETF stacks up. Is it outperforming, underperforming, or somewhere in between? This comparison can help you identify potential red flags or areas where your ETF might be falling short. Don't just focus on returns. Pay attention to other key metrics such as the ETF's expense ratio, trading volume, and dividend yield. These factors can impact your overall returns and provide insights into the ETF's efficiency and income-generating potential. Remember, tracking performance is not about obsessing over every tick of the market. It's about staying informed, identifying potential issues early on, and making adjustments as needed to keep your ETF portfolio aligned with your investment goals. Unveiling the tools of the trade resources for ETF analysis. In today's digital age, investors have a wealth of resources at their fingertips to analyze ETFs and make informed investment decisions. From comprehensive financial websites to sophisticated investment platforms, there's a tool for every investor, regardless of their experience level or investment style. Start with reputable financial websites like Yahoo Finance, Google Finance, and Bloomberg. These sites offer a treasure trove of information on individual ETFs, including real-time quotes, historical performance charts, expense ratios, dividend yields, and news articles. For a deeper dive, explore dedicated ETF research platforms like ETFDB.com and Morningstar. These platforms provide in-depth analysis, including ETF ratings, sector breakdowns, risk assessments, and portfolio construction tools. Consider utilizing investment research tools offered by your brokerage firm. Many brokerage platforms provide access to analyst reports, ETF screeners, and portfolio tracking tools, allowing you to analyze ETFs and manage your investments all in one place. Don't underestimate the power of social media. Join online forums and follow financial experts on platforms like Twitter and LinkedIn to stay abreast of market trends, gather insights from other investors, and engage in discussions about specific ETFs. Remember, information is power in the world of investing. By utilizing these resources and staying informed about your ETF investments, you can make more confident decisions and potentially enhance your long-term returns. Section 3. Setting benchmarks. Measuring success in ETF investing. In ETF investing, success isn't just about beating the market. Set realistic benchmarks and align investments with your financial goals. Define your objectives: retirement, a house, education, or a mix. Choose ETFs based on your time horizon and risk tolerance. Focus on your progress, not others. ETF investing is a marathon, not a sprint. Section 4. The power of patience. Resisting the urge to overtrade. In the fast-paced world of online trading, it's tempting to constantly tinker with your portfolio, chasing the latest hot ETF or reacting to every market blip. However, excessive trading can be detrimental to your long-term returns, racking up trading costs, triggering unnecessary tax liabilities, and leading to emotional decisions that might not be in your best interest. Think of ETF investing like planting a tree. You wouldn't dig it up every few weeks to see if it's growing faster, would you? You'd give it time to take root, nurture it, and let it grow at its own pace. Similarly, ETF investments need time to flourish. Constantly buying and selling can disrupt their growth potential and lead to suboptimal outcomes. Resist the urge to react emotionally to market fluctuations. The financial markets are inherently volatile, and short-term swings are a natural part of the investing process. Instead of panicking and selling your ETFs at the first sign of a downturn, focus on the long-term fundamentals of your investments and whether your investment thesis still holds true. Remember, time is your ally in ETF investing. The longer you stay invested, the more potential you have to benefit from the power of compounding. By reinvesting dividends and letting your investments grow over time, you can potentially turn small gains into significant wealth. Of course, patience doesn't mean being passive. It's still essential to monitor your ETF holdings regularly, stay informed about market trends, and make adjustments as needed. However, these adjustments should be strategic and well considered, not impulsive reactions to short-term market noise. Section 5. The Long Game, ETF Investing for a Lifetime. ETF investing is a long-term game requiring patience and discipline. Embrace a long-term perspective to harness compounding and ride out market volatility. Think of your ETF portfolio as a retirement savings account. Each contribution adds to your nest egg and benefits from growth. Start early to give your money time to compound. Market downturns are opportunities to buy ETFs at discounted prices. The stock market has historically trended upwards over the long term. Build a diversified ETF portfolio aligned with your goals. Review your ETF holdings periodically but avoid frequent changes. Stick to your plan and let your investments work over time. ETF investing is a journey, not a destination. Stay disciplined and educate yourself for potential success. Section 1. The Power of Smart ETF Investing. We've traversed the exciting world of ETF indexes, exploring the top global players and the strategies for maximizing your investment success. Remember, it's not about chasing the highest returns overnight. That's gambling, not investing. Smart ETF investing is like building a skyscraper, brick by brick, with a solid foundation of diversification. We've seen how ETFs like the S&P 500 and MSCI World open doors to global markets, offering a slice of ownership in hundreds, even thousands of companies. This diversification isn't about spreading yourself thin. It's about strength in numbers, mitigating risk by ensuring all your eggs aren't in one basket. Think of it like this. You wouldn't build a house with just a hammer, would you? You need a toolbox full of instruments. Similarly, your investment toolbox needs the flexibility of ETF rotation. As economic winds shift and sectors heat up or cool down, you adjust your sails accordingly, moving from underperformers to potential winners. But remember, this isn't a day trading frenzy. It's about calculated moves, like a chess grandmaster thinking several steps ahead. You've got to track performance, use the resources at your disposal, and set realistic benchmarks for yourself. Are you on track with your retirement goals? Is that down payment within reach? That's the scorecard that matters. Section 2. Stay informed, stay invested, stay ahead. As we conclude this exploration, let's be clear. Knowledge is power. The more you understand about your ETFs, the market forces at play, and your own financial goals, the better equipped you'll be to make smart decisions. Don't be afraid to get your hands dirty, digging into those analyst reports, comparing expense ratios, and really understanding what's under the hood of your investments. Remember, investing isn't a spectator sport. It's about actively participating, asking questions, and never stopping learning. And yes, there will always be risks. Markets ebb and flow, sometimes taking your portfolio on a roller coaster ride. But that's where patience comes in. Don't let short-term dips shake your long-term vision. Remember that skyscraper we talked about? Rome wasn't built in a day, and neither is a robust investment portfolio. Stay informed, stay invested, and you'll be well on your way to reaching your financial summit.